Stop buying SCHD blindly. I need to show you something that could save your portfolio when tech crashes. There's a value ETF that institutional investors are piling billions into, while retail investors chase dividends. And if you don't understand why this matters, you could lose years of gains in weeks. The market is more concentrated than it's been in 50 years. A handful of tech companies control nearly half the S&P 500. When valuations get this stretched, central banks start issuing warnings. When Goldman Sachs predicts 10 to 20% corrections, smart money repositions before the crowd panics. And yet most SCHD investors think they're perfectly safe because they own value stocks. They're wrong. SCHD is phenomenal for income. That 3.86% yield with quality dividend growers makes it a retirement portfolio staple. But SCHD holds only 103 companies, and 20% sits in energy stocks facing long-term transition headwinds. There's another value ETF with 318 holdings spreading risk across 3 times more companies. It costs even less to own, and it's consistently outperformed SCHD in total returns while still paying dividends. Most investors have never heard of it. It's VTV, the Vanguard Value ETF. Before you click away thinking this is boring, understand what's actually happening. When professional portfolio managers need broad value exposure without concentration risk, they choose VTV. The fund tracks 318 large-cap value companies at a rock-bottom 0.04% expense ratio. SCHD charges 0.06%. VTV is actually cheaper. The yield difference is real. VTV pays around 2%, while SCHD pays nearly 4%. But here's what the dividend-obsessed crowd misses. Total return matters more than yield alone. You don't have to choose between them. The smartest play combines both based on your actual financial situation. If you need income right now, retirement withdrawals, living expenses, SCHD wins. That higher yield matters when you're spending dividends instead of reinvesting them. Put SCHD in your Roth IRA where those dividends grow tax-free forever. If you're building wealth long-term, 10 plus years from retirement, you want total return, not just yield. VTV's lower dividend means less tax drag in taxable accounts. More money compounds instead of going to the IRS every April. Here's the tax math nobody explains. Same $200,000 invested. SCHD generates about $7,700 in annual dividends. VTV generates about $4,000. If you're in the 22% tax bracket, that's roughly $800 more in annual taxes with SCHD. Over 20 years, that's $16,000 paid to the government instead of compounding in your account. For maximum protection, split your value allocation. SCHD gives you dividend growth and quality factors. VTV gives you broader diversification and lower costs. Together, you're positioned across 421 different value companies instead of betting everything on 103. Here's what's controversial. Higher yield doesn't always mean better investment. SCHD investors love bragging about that 3.86% yield, but they conveniently ignore that VTV has beaten SCHD in total returns over multiple periods while charging less in fees. When you reinvest dividends, which most long-term investors should do, the lower-yielding fund with better price appreciation often wins. The math proves it. But admitting this means questioning whether chasing the highest yield was the right strategy all along. Most people won't question it. That's why they'll keep underperforming. SCHD's 20% energy allocation is a ticking time bomb long-term. I'm not making a political statement. I'm reading regulatory trends, capital allocation shifts, and technology advancement. Energy companies face structural challenges as the economy transitions over decades. VTV spreads exposure more evenly. Financials, healthcare, industrials, consumer staples, no single sector dominates. When one industry struggles, you're not overexposed. SCHD fans will argue energy pays great dividends. They're right, until those dividends get cut when business models face disruption. Just ask investors who thought telecom dividends were safe in the early 2000s. The AI bubble isn't about whether AI is real. It's about whether current valuations make mathematical sense. Companies trading at 700 times earnings, tech firms losing $3 for every dollar of revenue, billion-dollar valuations for startups that won't show investors their product roadmap. When bubbles pop, correlated assets crash together. Both SCHD and VTV minimize tech exposure by design. They're value funds, not growth funds. That's your hedge. But VTV spreads that hedge across triple the number of companies. More diversification means better protection when specific sectors implode. Stop overthinking this. Here's exactly what to do. Retirement accounts, Roth IRA, 401k, traditional IRA, these don't care about dividend taxes. You can hold whichever fund fits your goals without tax consequences. Want maximum income? Go heavier SCHD. Want better total returns? Go heavier VTV. Want both? Split it 50-50. Taxable brokerage accounts. This is where VTV's lower yield becomes a huge advantage. You keep more money working for you instead of paying unnecessary dividend taxes year after year. The portfolio pros keep SCHD in retirement accounts and VTV in taxable accounts. That's tax optimization in action. This week, calculate your actual numbers. Look at your current tech and growth exposure. If it's over 35% of your portfolio, you're over-concentrated when valuations are this stretched. Look at your dividend taxes paid last year. If you're in taxable accounts generating high dividend income, you're probably paying thousands in unnecessary taxes annually. Then decide your allocation. Don't just copy mine. Your timeline, tax bracket, and income needs determine the right mix. If you're 5 years from retirement, lean SCHD for income stability. If you're 20 years from retirement, lean VTV for lower costs and broader diversification. If you're defensive about market conditions, split between both to maximize value exposure across the most companies possible. When tech corrects, not if, when, value stocks will hold up better because they're already reasonably priced. SCHD and VTV both win in that scenario. But the fund with triple the diversification and lower expense ratio has better odds of outperforming when volatility spikes. More holdings means less single stock risk. Lower fees means more return stays in your pocket. The institutions already know this. That's why professional money managers choose VTV for broad value exposure. Retail investors chase the highest yield without understanding the total return picture. Don't be retail. You have 3 choices. Keep buying SCHD exclusively and hope those 103 holdings with heavy energy exposure work out long term. Switch entirely to VTV and give up significant yield for broader diversification and lower costs, or combine both strategically based on account type and investment timeline. The third option is what sophisticated investors actually do. SCHD for income in retirement accounts, VTV for growth in taxable accounts. Together, maximum value exposure with tax optimization. This isn't about abandoning SCHD, it's about understanding you have options most investors don't even know exist. The market will eventually teach this lesson to everyone. You get to choose whether you learn it before the crash or during. This is not financial advice. I am not your financial advisor. Do your own research. Consult professionals for personalized guidance. But if you found this valuable, drop a comment with which strategy fits your situation. And if you want more content breaking down what Wall Street actually does versus what they tell retail investors to do, subscribe so you don't miss it. The smartest investors don't follow the crowd. They position before the crowd realizes they're wrong. Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.